You're listening to the greatest multifamily investment advice show. My name is Adam Ras, and now I'm talking everything multifamily for an in-depth conversation, and I will be diving deep into raising capital, deals, and underwriting process. Welcome back to the greatest multifamily advice show. Today we have Gino Barbaro, an exceptional guest, a book author with more than 15 years in real estate investing, with different commercial spaces, more than 2,000 units under management, real estate mentor, and keynote speaker. Help me to welcome our guest today. How are you, Gino?
I'm doing great. I love the title of your show, Adam. It's Greatest Multifamily Investor Show. So everyone out there, a smart person is one who learns by their own mistakes. And then I am real smart because I've made a ton of mistakes and I've learned. A wise person is one who learns by others' mistakes. And that's why you're listening to this podcast, because you're here to listen to my mistakes. And I'm sure Adam's made a few of his own, but that's why we listen to these podcasts, right?
100%.
It's all about learning from others' mistakes and actually saying to themselves and being humble and saying, listen, they've done it before. Let me rip off and duplicate what they've done to see and emulate what they're doing. And hopefully I can put that into my own life.
Great start, and it's gonna be a great episode, I think. Learning from the master here. So we're gonna have a lot of advices and lesson learned, I think, today. So again, thank you so much for being with us today, and I appreciate you taking the time. Your background is super impressive on the last 15 years on syndication and multifamily and commercial spaces. But I would like to start with the beginning for you was 2011 and 2010. It was not a stable market. How was the beginning for you?
Adam, let's talk real back even quick farther. The reason for my success, I've got an amazing wife. We've got 6 children, and that's the basis for all that I'm doing this. I wish early on that my career was a fulfillment of my dreams, and it wasn't. Early on, I had a restaurant, and it was great the first few years. My dad passed away in 2007, and with that, I had worked with him since I was a little child. And that's what led me to multifamily, because in 2008, the Great Recession is there, and I'm questioning, why am I doing the restaurant now? It doesn't feel as if it's my dream. Why am I doing this? I need to find something else. And I went out like you and like a lot of other successful people. I went out and found mentorship. I joined Rich Dad, Poor Dad, and I found another mentor. Worked a couple of years for that. I met Jake at the restaurant in 2009. He was a pharmaceutical rep. I was the pizza guy, hence the drug rep and the pizza guy. In 2011, Jake moves down to Knoxville. And fortunately, I think God had an intention for us to go down there and to partner. He moves down there in 2011 from New York. And we start looking at deals, and it takes us 18 months to find that very first deal. We're a little slow, but after 18 months, the second deal. And after 6 months after that, our third deal. And you talk about 2011, very big differences to what there is now. Actually, the economy is pretty similar, although now we don't know what a definition of a recession is anymore. Inflation is transitory. We don't know what the hell they're talking about. But at that time in 2011, there was no money for syndication. Cap rates were really high. There was a lot of risk in the market. Our very first deal in 2013, 1 bedrooms were $350. Now that same 1 bedroom, because we still own the asset, is $995 plus rubs. Wow. So rents have more than tripled. We still own that asset. So there's a lot of risk in the market. Deals were on LoopNet. There was no appetite for investing. So Jake and I, our first deal, we used creative financing. We bought our first 25-unit property with seller financing, 10% down payment from our pockets, 10% seller financing, and 8% from the bank. And I think that's where we're going. That's where this part of the market cycle is heading. We talk about the 3 pillars of real estate we've created. We've trademarked it. It's market cycle, it's debt, and it's exit strategy. We've put all 3 of those together. These concepts are all out there. But for every investor out there, I really want you to focus on these 3 pillars. Market cycle first. When we started, it was definitely a buyer's market, right? Sellers had no choice to sell, right? They had no posturing like they do now. Buyers had all the advantage. And that was a mistake that we thought. We don't need the brokers, when in actuality, you always need brokers, because brokers are always going to bring you deals. Back at that time, the market cycle, you could buy C assets for really high cap rates. As the market has gone higher these last 7, 8, 9, 10 years, cap rates have compressed. So in this part of the cycle, we're buying assets that are newer, because cap rates are very similar between a B and a C asset, right? Plus, we're also thinking in decades. We want to own these assets for longer. That's why we're buying newer assets in this part of the cycle. When prices readjust and they go down, it's not like we're not looking for older assets. We're still buying older assets, but we really need to buy them at the right price point. That second pillar, everybody, is exit strategy. When we bought that first deal in 2013, we didn't have an exit strategy. We thought buy and hold forever, which for the most part we've done. But at some point, most people out there, what they need to do is to start buying assets and putting them on what we call a conveyor belt. A conveyor belt is this imaginary belt in front of you. You start putting assets on top. And as you get along the conveyor belt, year 1, year 2, year 3, these assets start matriculating. You're either going to exit the deal by selling it, you're either going to continue to hold it, or possibly refinance it, get the equity out, and start buying more assets. You may start with a 2 unit, then a 10 unit, then a 20 unit, then a 70 unit, but you need to start. And now is as good a time to start as any. And the third one is the debt. Now, if you don't know what kind of exit strategy you're looking at, how are you going to find out what kind of debt? If you're buying hold forever, you may go with an agency loan that has yield maintenance because you're going to hold this thing forever. If you're doing short term, like you were talking about, maybe you go with bridge financing. If you're going with a little bit longer term, hey, let's look at community bank or a credit union. So everybody out there, write those down: market cycle, debt, and exit strategy. Know what part of the cycle your market's in, because right now there's some markets like Oakland, California, that are still in recession. And there are some markets that are in hyper supply and expansion that are, one of them's in a buyer's market, the other one's a seller's market. Know where you are, know the type of asset. And finally, ultimately, I want everyone listening to this, from knowing what part of the market cycle you're in, understand what your buy right criteria is. Now, what do I mean by that? We teach buy right, manage right, and finance right. In the buy right criteria, it's very important to understand what assets you're focusing on. For us, we're looking for assets that are 1980s and newer. We like assets that are 2 bedrooms. And we'll take 3 bedrooms. We'll even take 1s. But if we get 2-bedroom townhomes, dude, every day. Brick, we like washer dryer hookups. We like those type of amenities. We like median incomes of at least $50,000. We'll look at certain submarkets. We like to look at population growth, job growth. These are all metrics that we're looking for when we're buying an asset in this part of the cycle. Now, when a deal comes to us, you can look at it real clearly and say yes, yes, no, no. That focus and that determination and that resolve doesn't, people always say, hey, I lack the motivation. No, we don't lack the motivation. We lack the clarity. That buy right criteria will give you the clarity, along with the market cycle and debt, to be able to formulate a business plan that's unique and special to what every person's situation and circumstances are listening to this podcast. Because I'm a little bit older right now. I don't have to force myself into doing deals. I'm very comfortable with my deals right now, and I can be more selective. Other people are looking for deals that have capital appreciation. Others that are older and want to be retired, they might want a little more cash flow. So understand what your goals are, what you're trying to accomplish. And by doing that, let's work on what your business plan looks like. Let's work on what your buy right plan looks like. And let's focus on those 3 pillars of real estate to help you pull all of this together. Does that make sense?
Yeah, it is. But one of the things you mentioned is your stage right now. I see a lot of new investors, when you start, they focus on more product like C products, not a B product, because of price wise. But you right now, you're making a point. I like it, which is, right now, the cap rate is already compressed. It's already is really close, the B and C. And even now, I see more experienced investor with more 10 and 12, when they have already a big portfolio, they focus more on even a product number A, like a product. So I like what you're saying about this. But my question is now, what is the upside of your market now? You're before the show, we were talking about, like, your model is not about syndication. So you're mentioning more about buy and hold by yourself and doing a refinance. But right now, with the new interest rate, how is your strategy is going to change because of the higher interest rate?
Great question, Adam. We read a book called Small Giants. And if you go to the Jake and Gino channel, on our podcast, we interviewed Paul Spiegelman, who is the founder of Small Giants. And it was a great book because it really gave us clarity to what we wanted. We don't want to be the next private equity firm. We want to have a nice company that has 20% year over year top line revenue growth. And that's a mixture of rent growth, mixture of buying deals. So right now, very comfortable. We're going to hit that by the end of this year. That's what we want. So we're not out there chasing tons of deals. We want to do the right deals. That's what it is. And like you said, in that part of the market cycle, when rates were lower, we were able to refinance over $25 million out of that portfolio. And that conveyor belt really worked. Continue to buy and buy and buy. Right now, rates are going up. So what you're looking for is that long-term fixed rate financing. That's what you're looking for right now before these rates go up. As they go up, pricing has to go down. So basically, it's if pricing is here, rates are going up. Sellers have to. I've been talking to brokers. Prices have to go down. So you're going to pay less, but your date's going to be more. So you're still going to be back at square one. At a certain point in time, they're raising rates to slow down the economy, to get us into recession, and to actually, try to tamper inflation. At some point, they're going to start dropping interest rates again. That's when you refi back out of the product right now. Right now, what you might be thinking of is, let's go to that longer term fixed rate financing, where a lot of these deals are underwriting 5 to 7 years. Coming up through the first wave of that cycle, 13, 14, 15, 16, 2018, people were buying deals and flipping out of them real quick. They were adding value. They're underwriting for 3 to 5 years, but in many instances, people were flipping out in 18 months. Now is the time of the operator. The operators are here. You're buying these assets. You better hope you have your managed right. We have the wheelbarrow. Buy right in the back leg, finance right back leg. The wheel of the wheelbarrow is the managed right. If you can't manage the asset, make sure somebody can manage that asset, because you're going to have to hold this deal for the longer term. And you know what? Guess what? That's good for the operators in one perspective, in one sense, because rents are going to continue to rise. So you're buying these assets, you are going to continue to raise these rents because of inflation and because of what's going on with the single family market. There's not enough supply right now with single family homes. And people, when rates go up, guess what? They can't buy a home. What do? They continue to rent. So there's a lot of opportunity for multifamily going forward. I just think right now, as far as refinancing, rates are a little bit higher. You may add a supplemental loan onto what you have. You're just going to pay more for that debt. So it really depends upon, do you want to extract that equity? And if you want to extract the equity, you could either refi at a higher rate or you sell. And Adam, you made another great point about people focusing on when they're new, they're focusing on older assets. We all learned that lesson early on. We get drawn in by those higher cap rates. Higher cap rates. Oh, more cash flow. ROE. I want everyone to write that down. It's called return on effort. Return on effort. Because those C properties, there's a lot more work. There's a lot more upside. But if you're overpaying on them and you don't do a proper budget, which is what a lot of people do, a 1960s product has cast iron plumbing, it has roofs, it has driveways, it has HVACs. All of these things need to be replaced. That's why these operators now are focusing on the newer assets, because there's less CapEx requirements, there's less effort involved. And if you hold these for the long term, an asset gets older, but a 1980s asset is a lot newer than a 1960s asset. And you could hold it for another 10 years. So that's why the market cycle is very, very important. If you can buy an older asset for the right price and you can budget for these repairs and still make it work, go ahead, do it. We've done it. We had bought a 25 unit in December of this year, past year. It was 1973 build, but we gutted the entire thing. New roofs, new driveways. It's practically a brand new asset. But we bought it at such a good price point that now, and with rents rising dramatically, it's a home run of a deal for us.
Yeah. Gino, you mentioned before the show that your model is not based on syndication. But my question is, what is the upside for you to basically to do more like a buy and hold and refinance versus syndication when you're more focused on raising capital?
That's a great question. For us, it's all about core values. Once we really established our core values and what our mission statement was, Jake and I really wanted to have a company that we can grow slowly. And what we focus on profit per unit. We want to see how much each door gives us in profit. We're averaging between $250 and $300 profit per door in our portfolio. Now, most syndication companies, they don't do that. They focus on capital appreciation and exits, which is great. It's great to get deals on the conveyor belt. You're also creating another stream of revenue. You have acquisition fees, you have asset management fees, you're building a business from there. Jake and I got to a certain point where we're like, you know what? Syndication model is great, but we really want to build a company. And when you're vertically integrated, which means that you're doing your own property management in-house, you're raising your own capital, you're buying these deals, you're doing all the work in-house, you cannot grow as quickly as a syndicator does, because syndicators, a lot of them have third-party property management. So it's basically, I come back to what I was saying earlier on. What are your goals? What are your values? We wanted to get to a certain point. And for me, it's not about growth anymore. It's not about having 10,000 doors. For me, it's about having a nice portfolio that will perform, that gives us less effort, that's a lot easier to manage and to hold for the long term. That property that we bought in 2013, we bought it for $600,000. It was 25 units, and we've refied $180,000. We've refinanced all of our money out of it back in 2015. 2 years later, we still own the property. The property is probably worth $2.5 million right now.
Wow.
So we have $2 million of equity in that property,
Yeah.
and the debt on that property is 400 grand. It's giving us $9,000 a month in cash flow every single month. That property is putting my kids through college, right? Because you see
Just
what
one.
happens with the rent. Just one.
Yeah.
But that's the power of owning something for the long term.
Yeah.
Because most people get the shiny object and they say, hey, and we've done it. We bought an asset back in 2016 for $37,000 a unit. We sold it last year for $100 a door. It was only 8 units, but $500,000 in profit.
37 and what?
30 in Knoxville back in 2016. We bought it for 37 a door. That's what they were trading for. We got a deal. It should have traded for 50, but we bought it for at a discount.
37. Okay.
So my point is, we sold it for 100 a door. We thought we were champs. Well, a year later, the property's worth 150 a door. So who's the champ and who's the sucker? So for me, that was a learning lesson. It was a good asset in a good part of the market, nice build. We probably should have held on to that asset, but we got shiny object syndrome. We're like, you know what? We can cash out. We should have probably refinanced that property, looking back in hindsight, but that's one of the mistakes we made. We should have probably held on to that property.
Let me jump again to your major the upside of your market. Where you focus right now on your market?
So we're located in Knoxville, Tennessee. We're within 3 hours of Knoxville. So we can hit areas in North Carolina, Huntsville, Alabama, Chattanooga, Tennessee, Nashville. We have an asset in Lexington, Kentucky as well. So within 3 hours that we can drive. We like the east part of Tennessee as well. Johnson City, Kingsport, all those areas there. We love that. We love that part of the market.
More closer to Georgia, Carolinas, and Alabamas.
Yes. Yeah, and that's a function of Jake living there, but also that's where the growth is. That's where the population growth, that's where the job growth is. That's where the cost of living is still reasonable. And that's where people from California are moving to Knoxville, Tennessee. That's never happened before. It's happening now. And from California, from Arizona, from New York, they're coming to Tennessee and they're coming to Florida. So we're just fortunate that we're in a market that's emerging and we have assets in that market.
I think this is basically my next question, which is I see how you see as a long-term market fundamental with the new net immigration, especially that right now, as you mentioned, the Southeast is the winner. The Southeast or the Middle East is the winner of the market. Georgia, Carolinas, Tennessee, of course, Texas, not all of Texas, but how you see the long-term fundamental, if it's going to stay like this, or you seeing like an actual reverse of the net immigration?
We just did a podcast about 6 months ago with a gentleman named Ken Grombach. Yeah. Once again, go to the Jake and Gino channel. He's a demographer, and he's actually an entertaining demographer. And he talks about the migration. And back in 2012 and 2013, everyone living in Florida was freaking out because business was terrible. And he's saying to everybody, don't worry about it. I see the demographic changing. The 60-year-olds are retiring. They're coming down. And the same thing with the millennials. They're all coming down. So from a demographic perspective, this is a shift from back 150 years ago. Everyone was fleeing to the Northeast and leaving the South because of the opportunities. Now it's the reverse. Now what's happened in the South, and you're seeing it with Chicago, the billionaires in Chicago leaving to go to Miami, the hedge funds from New York and New Jersey leaving to go to South Florida. You have a much more educated workforce in the South. That's really important. Same thing in Texas. You have Austin, San Antonio, Houston. You have Raleigh, North Carolina. You have Nashville. These are very educated cities now, and employers want that. The weather, the taxes, the quality of living, that's going to continue. People used to come to Florida because they wanted to leave the Northeast. They were tired. They were tired of the weather. Now it's a combination of weather, politics, freedom, quality of living, cost of living. And that migration is going to continue unless or until New York wakes up and says some of these policies we're enacting, they're not really helping us. They're not really helping our state. I don't know if that's going to happen. That shift is going to continue to occur because as people retire, they don't want to stay in the cold weather anymore. That's the reality. When you see Chicago, you see parts of New York. The only thing that saved California is truly a beautiful place to live. I mean, it's the scenery is beautiful. The wineries are beautiful. The ocean's beautiful. And that's why people are still there. But if they were, like I said, in New York, you're not going to live in the middle of New York in the middle of the wintertime. You're leaving, and that's what I see happening. And I'm in North Florida right now. The growth here in North Florida is it's truly astounding, to be honest with you. They're looking to build 100,000 homes in the next 5 years. I've never seen so many churches being built, schools being built, roads being built. The infrastructure is growing in front of your eyes. I've only been living in Florida for 5 years, and the massive change that I've seen in the last 5 years, and that's a testament to the leadership. The leadership here in Florida, from what I've seen, has really taken this head on, and they projected this growth. And they said we need to focus on the infrastructure. And when the state is a $21 billion surplus, they're doing some right things here. They're attracting businesses here, and they're attracting people who want to live here with no state income tax. And you have a $21 billion surplus. Somebody's doing something right down here.
100%. As an expert on Tennessee, especially, what do you see like a upside of Knoxville versus Nashville versus Memphis?
So first of all, I am not an expert on anything. Experts are people who they stop learning and they think I am the totally growth mindset, because there's always something to learn, because things are changing. 5 years ago, Knoxville was sleepy. All the money was in Nashville. And all of a sudden, the Nashville money at the 2 and 3 caps has migrated over to Chattanooga and has migrated to Knoxville. Knoxville is still, our rents 2 to 3 years ago for 2 bedrooms were in the 600s and the 700s. They were still pretty low around the pandemic. In the last 2
Only
years,
700.
That's what it was, 750. Now they've shot up to 11 and 1200 because they see the dislocation. You can't afford Nashville, so you're moving over into Knoxville. And I think Knoxville's done a very good job managing their growth. It's a nice little city. It still doesn't have that sprawl or that feel of a big city, and they've been managing their job growth and their population growth really well. I love the city. Chattanooga is one that I can't figure out. It's an expensive market as well. Nashville is just going to start going out. You just got to start going out to the suburbs of Nashville and finding value there. But I personally like Tennessee as a state to invest in. We love it there.
Memphis. How you think about Memphis?
That's a tough one for me, because Memphis is a city where you really need to know where to invest in. It's one of those things where it changes neighborhood by neighborhood. There's the allure of those high cap rates. The problem with Memphis that I see when you're looking at occupancy, a lot of these buildings are physically occupied, 90, 95%. But with economic occupancy, what is that? It's 70, 75%. And that means an economic occupancy, are they paying? So you have like 3/4 of your tenants paying, whereas 95% of it's occupied. So that's what frightens me about Memphis. And if you start going out to the neighborhoods that are really, where there's value and where there's, the assets are a little more expensive, I might as well stay in Knoxville, because I'm going to be paying the same cap rates and same prices, and Memphis is 7 or 8 hours away from me. So just be careful with Memphis. When you go there, make sure you understand the neighborhoods. Make sure you understand where median income is, and you're going to buy assets at a discount in those rougher neighborhoods. But those neighborhoods are a lot harder to manage. Just be aware of that.
Let me ask you something about recession right now. As you mentioned on the beginning about the exit strategy for your deal, and as I mentioned right now, with uncertainty about the rates, so with the lenders, how you have your risk mitigation plan with the current rate, especially if you're planning for exit with refinance or selling?
That's a great question. What we're looking at right now is in community banks. I don't know what the rates are now, but we would look at a community bank, and we're buying these deals based on a pro forma, not the broker's pro forma, but our pro forma, because rents have risen so much. And these mom and pops, when you're buying these deals, there's no cash flow day one. So what we would do is we're getting a loan to cost with our community bank, 80% loan to cost. So we're looking at these deals where they're funding 80% of the rehab. We got to get these things funded, fixed out. This 25 unit deal we bought in December, it's ready to go to refi right now. We've already done all the work. We're ready to refinance it back to community bank. Unfortunately, like you said, the debt we had on in December was 3.5. The supplemental loan is going to be around 5%. So you're just going to have to pay for more expensive dollars as far as debt goes. But you're just going to have to be careful as far as what we're using. That's why we don't want to use bridge debt from an agency, that non-recourse, because it's going to be a lot more expensive, a lot more closing costs. And where is it going to go? And right now you need to underwrite for a higher rate. I'm hoping that a lot of people didn't buy 6 months ago at 3.5 and they're underwriting for a 4.5 exit. They may get stuck. Their only saving grace is that rents have gone up so much that they may get saved that way. But for us, getting that loan to cost, refining out that loan to cost, getting it more fixed, and then holding it for the long term, that's what we're trying to do. I don't want to do all the work, Adam, on a property. Get it repositioned, get it rehabbed, get it churning, and get it paying to me, and then a year later just sell it. There's so much work involved in that. 100%. So we want to be more selective in our assets, and there are deals out there. So for your question specifically, when you're underwriting a deal, focus on the exit strategy, because you may find a little 20 or 30 unit deal that's vastly undervalued. You see that, go in there, fix it up, and then go out and flip it. That's maybe that short-term debt. But if you see a legacy asset that you like, that's, man, this is a great market, great area, great build. I love the unit mix. There's so much value here. I can see owning this for the next 10 years. Get the fixed rate financing on that deal. That deal is worth holding for the long term. So figure out what your strategy is on a deal, and then you do accordingly whatever type of debt is corresponding to that strategy.
The hard question will be now, if the people asking about Gino, what is his superpower?
My only superpower is that I work hard, and I don't really quit. I mean, think about it. There's so many successful people out there, and when I look around, a lot of people, we're just not smart. I'm not that smart, to be completely honest with you. I just read a lot of books, and I continue to make mistakes, and I continue to try stuff, and that, I think, has been my superpower. If I go back and listen to my first few podcasts, they were dreadful, but I didn't quit. I wanted to get better, and I just continued to practice and practice and practice.
Yeah.
And that's basically my superpower.
How you see as a mentor right now, and you're helping all of your students to grow and scale their portfolio, how you see this as like helpful in your business itself? I know that they're not helping you, but in you as a in your career, how you see the mentorship on your life?
You know, what I was taught to do is I was taught to learn a topic, then I was taught to do it, and then the third part is to teach it. And when you teach something, you really have to practice it. And we're lucky because we're not only just teaching about it, multifamily education, we're buying assets. We're participating consistently with it. And I'll give you a couple examples. Like I was just talking to you, we just had Steve Robinson, one of the Chick-fil-A CMOs, on our podcast. That hour that I spent with him, part of Jake and Gino, I learned so many things about culture, about building a brand, about building a business, about stewardship, just from that hour that we implemented in our own business. Being able to interview all these amazing people has helped us become much better investors, have given us much more clarity. Like I said, the Small Giants interview with Paul Spiegelman, it gave me clarity on what we wanted to do. We had a 1 hour call with our students last night, state of the market. Well, guess what? I have to know what the state of the market is. I have to know what interest rates are. I have to know about, inflation. I have to know about the recession. So it keeps me sharpening my pencil almost daily to know what's going on, and then to utilize that for my portfolio. Because as far as education goes, you can make a good living from it. But owning these assets and creating wealth from there, there's no comparison. That portfolio is much more profitable. For me, the education is much more impactful, and I enjoy that part of the business more. So
I'm just messenger here. I know that you have a really famous podcast, but I want to hear it from the master here. How the people can reach you and find you and Jake?
Just go to jakeandgino.com. When you go to the website, you'll see all the podcasts there. I do one specifically with my wife. It's called the Julia and Gino Show. And I personally love that one because I've had people come on the show and say, anybody can learn a cap rate. Anybody can learn cash on cash return. But what you're teaching about family. You're teaching about core values for a family, because family and business are very similar. The way you run a business is the way you run your family. You have to have what we call cadence of accountability, rhythms. You have to have touch points. You have to build a culture within your family as well. And I love doing the podcast with my wife. It's giving back, and it's really having, people on. I have priests on my podcast. I have personalities. I've had Dr. Gary Chapman, the 5 love languages, on there. People need to work on their relationship. And if you're with a significant other or a spouse, how do you, even if your spouse doesn't work in the business, how do you communicate, and how do you help each other out? My wife could care less. She doesn't know what a cap rate is. I say refi and roll. She could care less. It's the reality. But at the same time, she supported me throughout this entire journey. And without her, I wouldn't be here. So I think spouses need to understand that they can still help, and they can still participate, and then still being there is really important. And I want to convey that through the podcast and through the shows. And that's one way we do it.
100%. I agree. I was trying to explain to my wife the cap rate and all of this stuff. For her, it's not a good subject. She likes Turkish shows anyway. So let's go back. I think I have to tell you again, I appreciate your time. Really, we appreciate your time to come to the show, and we're really happy to bring you again to the show, you and your wife, to talk more about your success on syndication. And again, thank you, man, for your time.
Adam, I appreciate it. I had a great time. Take care.
Thank you a lot.